Hey everyone, welcome back to Corporate Decoder, the place where we try to understand what companies are really doing. Today we're diving into the financial world of AEI Income and Growth Fund XXII Limited Partnership. Don't worry, I can barely say that name myself. Let's see if this partnership is really growing income or just growing debt. This company is a limited partnership that focuses on buying and leasing commercial properties. Think single-tenant buildings rented out to businesses. What makes it interesting is how these properties are managed and whether it's a good deal for the investors, the limited partners. We will analyze their financial health and explore the risks and opportunities they face in the commercial real estate market. First, this is their annual report, which gives an overview of their performance for the entire year of 2024. The report includes key information about the company and the numbers that show how it did. The partnership started back in 1996 to buy commercial properties, rent them out under what are called net leases, and then eventually sell those properties for a profit. They don't plan on borrowing money to acquire additional properties. In 2021, they actually tried to get permission from the limited partners to either keep the partnership going for another 5 years or to sell off everything and close it down, but neither plan got enough votes. So the partnership continues to operate. In 2024, they sold one property. Overall, they had interests in 3 properties with a total cost of about $7 million. It is worth mentioning that the partnership's income relies on a small number of tenants. If any of those tenants were to fail, it would be a major problem. They've been working to improve their cybersecurity. With the help of outside experts, they train their employees to spot and report cyber threats. They are focused on preventing unauthorized access to their networks and applications. So far, they haven't had any major cybersecurity problems, but this is an ongoing risk. Their goal is to find properties that will give them regular cash from leases, growing lease income over time, keep their capital safe, grow the value of their properties, and have stable property performance with long-term leases. The properties that they own includes an Advance Auto Parts store in Indianapolis, a DaVita Dialysis in Hempstead, Texas, and a Taylor Chris Plasma facility in Dallas, Texas. As of the end of 2024, there were 562 people who owned a share of the company. These units aren't publicly traded. For the year, distributions to the general partners totaled about $8,300, and distributions to the limited partners, the regular investors, totaled about $268,000. These are not like stock dividends, but rather a share of the partnership's cash flow. The partnership estimated that each unit was worth $615. This is just an estimate. To estimate that value, they took the total value of the partnership's assets, subtracted its liabilities and the value of the general partner's interest, then divided the result by the number of units outstanding. Here are the numbers that were used to calculate the estimated value per unit. The value of the properties was about $6.5 million. Their cash was a bit over $200,000, and after subtracting current liabilities and the general partner's interest, the value available to the limited partners was $7.2 million. There are approximately 11,749 units. The management cautions that the following numbers are simply estimates and they may be affected by market conditions and economy. A key part of their accounting involves deciding how to allocate the purchase price of properties they buy. In 2024, their rental income was about $440,000, down from about $547,000 the previous year. This decrease was due to a property vacancy and subsequent sale, offset in part by rent increases on one property. The expectation for rental income for 2025 is about $46,000. They had about $116,000 in administration expenses to affiliated parties and about $70,000 in administration and property management expenses to unrelated parties. During 2024, their cash balance increased significantly thanks to the sale of one property. Cash from operating activities decreased from $439,000 to $9,000 due to a drop in rental income. Okay, let's move to the financial statements. Their cash on hand significantly increased from roughly to over $900,000. Real estate holdings decreased from $6.6 million to $5.7 million. This is a result of selling a property. Limited partners' capital account decreased from $6.7 million to $6.4 million. Rental income declined from $547,000 to $440,000. Net income overall was only about $16,000, a major drop from the previous year's $51,000. Cash flow from operating activities decreased from $438,000 to $291,000. That was the financial report. Now, what's my take on all this? Seems that AEI Income and Growth Fund, XXII Income and Growth Fund, XXII Income and Growth Fund, KEDS-IA Limited Partnership, is facing some challenges. The financial results for 2024 show a concerning downtrend with declining revenues, lower net income and reduced cash flow from operations. One of their key weaknesses is reliance on a small set of tenants, and any problems with them could seriously hurt the partnership. Their administrative expenses seem high. The sale of a property boosted their cash balance, but it also reduced their overall real estate holdings and potential future rental income. However, the company is taking steps to improve cybersecurity, indicating a proactive approach to risk management. Their investment strategy focuses on long-term net leased properties, which aims to provide stable returns. Bottom line, it's going to be important to keep an eye on how well they manage costs, diversify their tenant base, and maintain the value of their existing properties. Thanks for watching, and if you found this decoder ring helpful, please like and subscribe for more. Let me know what reports you want me to cover in the comments.